Crypto Bros. Hope you guys are having a great day wherever you are and you're enjoying the current state of the market. Today we're going to be talking about how I believe Zen can do very, very well and why it's built into the protocol for it to essentially 100 or 1000x from the current prices. So before we can actually understand, Zen fully, guys, before we can understand Zen fully, you have to kind of understand the current economic landscape and how the government and the Federal Reserve work and the banking system, in essence, operates. So there are two ways the banks essentially make money. Okay, and how the banks are currently tied to the current collapse of what's happening. So the first method of how banks essentially make money is they get access to freshly minted capital that's hot off the printer. And one of the ways they get access to that fresh minted money supply is show their balance sheets, right? Their assets and liabilities, what they hold in the reserve, and how much customer base they have, and all that. And then in turn, the federal government says, okay, you look good. We're going to lend you the fresh printed money at 0% interest rate. Okay, and that's what the Federal Reserve is doing during the 2020 2021, is that they were providing a 0% interest rate and lending out money. So that's one way the banks were getting access to money. There was also a law or policy that was passed that noted that in 2020 that the banks did not have to hold, literally they could have had 0% reserves in their banking system, which still allowed them to basically get fresh minted money from the Federal Reserve. So a policy was passed by law by the government that noted during 2020 to basically drive growth. Again, going back to how the banks make money, the first method is that they essentially take that money from the Federal Reserve and they basically lend it out. And what that's supposed to do is essentially drive growth in the economy, make you spend, do all that stuff, right? And that's what was the main message the Federal Reserve was passing to the banks, to basically go ahead and lend out as much money as. So in essence, they were rewarding bad behavior in some sense. So what started happening is that they lent out the money to car loans, credit cards, mortgages, all kind of stuff, and the customers were just eating that up, right? They were taking as much loan as possible. Capital was cheap, yada yada yada. So they're lending out this money to the little guy, to average Joe, and average Joe is basically paying 2% or 3% interest back to the bank for basically taking that loan out from the bank. And because the banks took the original money from the Federal Reserve at 0% interest rate, they don't have to pay anything back. So now what you're starting to see is interest rates basically crawl up. The Federal Reserve is raising interest rates. And now what you see in turn is that the banks are raising their interest rates on their credit cards, their car loans, their mortgages, everything, so that they can keep up with the demand of what the federal government is doing with the quantitative tightening. So that puts pressure on the little guy, and when the little guy, the average Joe, can't basically make payment, he's trying to work 2 to 3 jobs, trying to keep up with the interest rates. He can't. He basically forecloses on his home and all that stuff, and he can't pay back his credit card. So in turn, this is bad for the banks, and in return, this is bad for the Federal Reserve as well too. But this is one how the banks essentially make money, is by lending out at cheap interest rate. But now the banks are not really making any money because the interest rates are so high, so it's very difficult for them to actually keep up with the Federal Reserve. Now the second way that the banking system makes money, which is what we saw with Silicon Valley Bank, and why that was a big problem. So the method to how banks actually make money is that you have average Joe. Essentially, he goes in to his bank and he deposits $100, okay, into his saving account. And the bank says to him, okay, we're going to pay you 1 to 2% interest rate on you keeping your money in the saving account. Now, the bank in turn has to basically try to go and get that average Joe his 2%. So what they're going to do is essentially they're going to lend out his money at a higher interest rate to someone else, or they're going to be going and buying bonds. Okay, so we're gonna discuss a little bit what bonds are. I know I'm throwing a lot of information at you guys here, but I'm gonna give you a bit of a detail what bonds are. So bonds are basically you're basically lending out your money, in return you're getting a bond. And what a bond has is it has an interest rate attached to it. So in turn, when you lend out your money, you're getting interest rate in return for that. So that could be 2 to 3% or whatever the case may be. So in turn, what these banks were doing is they were going out and buying bonds from the government. So anybody can issue bonds. The government can issue bonds, the banks can issue bonds, the institutions, companies can issue bonds. So what the banks were doing is they were going out and buying government-backed bonds. Okay, and they were buying like a 10-year bond. And in turn, the government was paying the banks, let's say 3% for 10-year bonds. So in return, they're giving 2% kickback to the average Joe, and they're keeping essentially 1% for themselves. So what's happening here in essence is that, let's say average Joe comes back, demands his money back from the bank. Now, because of the fractional reserve currency policy that was set in 2020, that told them that they don't have to hold any or at all any amount of money in the bank, in the banking system, they're kind of in big trouble there. So now what they have to do is they have to kind of liquidate their bonds at a cheaper price. So they go back to the government, they say, hey, average Joe wants his money back, so can we go ahead and sell our bonds just so we can cover average Joe's deposit. Now if enough average Joes come out and demand for their money back, you could see how this could be a problem in regards to their balance sheet, how much they've lent out. It's just the simplest term I'm trying to explain to you guys in terms of, so you can see where the banking failure happens. Now, before all this happens, of course, the government has set an insurance policy in place called the FDIC, where it says, hey, we're going to cover average Joe. Okay, we're going to cover average Joe up to $250,000 per account. If he wants his money back, we give it back to him. But however, we're not going to cover you as the bank because, look, you've lent out too much money, your balance sheet, you're incompetent, you don't know how to manage your your liabilities and assets. So we're not going to bail you out, but we're going to bail out average Joe. However, if each bank has incompetent balance sheet, then you can see where that could be a problem. The government insurance policy only covers up to $20 billion. Now, currently, the banking system has about almost $19 to $20 trillion injected into it. So you can see how that insurance policy is not even close to enough where it is enough to cover the average Joes around the world. So that's where you will see a lot of bank failures happening. So my whole point to this is that, look, the Federal Reserve or the government is incentivizing bad behavior by printing more money, lending out money at lower interest rate, and turn then raising interest rates, and then on top of that try to protect the normal average person by printing more money, which in turn causes even more problems and more inflation. So you can see where this is all connected and has a big actual problem. So why am I talking about this? Because Zen, at the end of the day, incentivizes good behavior. How does it incentivize good behavior? Well, Jack Levin, the founder of Zen, essentially built Zen to be an inflationary. However, in order for Zen to become deflationary, there has to be projects building around it. Okay, so you can think of it as Zen being the Federal Reserve, or you being the Federal Reserve because you're the one minting Zen. So you can go on the Zen.network and you can essentially mint your own Zen. However, how is it incentivizing you to essentially have integrity in terms of the protocol itself? Well, when you mint your own Zen, you're actually, again, you're minting your own yield. In return, you're actually staking it for a certain amount of time. Now, the longer you actually stake it, the bigger the reward. The less you stake it, the less the reward. So the protocol itself, it's built in to incentivize you to hold its integrity at the end of the day. And how can Zen become deflationary? Well, the more projects that come out on Zen, for example, we've seen with Dbxen. So Dbxen is a project of Zen. Basically what it does is if you into Db and you can go ahead and burn yours, in return you will get Dbxen. So what is Dbxen? Dbxen is the reward token that is provided to you by burning Zen. And Dbxen is a limited supply. So meaning the more people that burn Zen for Dbxen, the price of Dbxen actually goes up into the right. And that's what we've been actually seeing over the past a couple of weeks since Dbxen has been coming out. So the more people that actually burn Zen, the more for Dbxen, the more of Dbxen price actually goes up in this case. So you can see how the integrity of the protocol is held, and it's built into the protocol for it to be deflationary. So the more projects that build on Zen, the more the price goes up for Zen, right? The more you see up and to the right. So that's why I say that Zen can actually reach the levels of 10 to 20, 30, 40, 50, 60%, 60 cents and some. So it all depends on the community, right? It depends on the projects being built. So the reward token, so how many people come out and start burning. So currently you can go to dbxen.org and you can see that one badge, if you burn 2.5 million, that is one badge of Zen. And basically you will get Dbxen for that. Now I've already burnt that. I've received 1.52. And even in Dbxen, it holds integrity where you can actually stake it and continue to hold your Dbxen and turns driving price up. So a lot of cool things. Now the only way to burn Zen again is you have to essentially use gas fees, Ethereum gas fees. Now the cool thing about this, let's say if we were to enter the bull market, right, in the next year or two. Now we know what happens when the bull market comes. That drives up gas prices up. So more people are going to be probably inclined to actually buy Zen than actually mint Zen. Because you can see so far, since Dbxen has come out, it's burned about 619 billion Zen already, which is more than what's actually being minted. So even if the prices of gas fees are really low right now, think about what's going to happen a year or two when the bull market actually starts and people are going to be less minting and actually burning more and buying Zen up. So it's designed to actually go up. So you can think about it as the projects are the banks and you are the Federal Reserve in some sense. So it's giving power back to the people, which is the cool part about all this. And yeah, I mean, guys, innovation is happening. Again, phenomenal work has been done here. Now, does it translate well for the price? Again, this is yet to be seen, but I like the idea. I like the project. I like what's happening with it. Again, you know, I made a tweet, guys, about this to show you guys, look, I'm in Zen. I'm invested into it, not financial advice. Do what you will with this information, but I got in at 110. And right now, from that March, we've gone up about 211%. Guys, innovation is happening. You want to be on the right side of innovation, guys. Anyways, guys, I'll leave you off with that. I hope you enjoyed this video. Until next time, as always, stay profitable.